question. This is really a simple question, very, very simple question. Part B, part C, I mean, we start with C. C. So C there. So part C, Simon Cobier, an investor, is evaluating 6 portfolios with the following characteristics. So I can see portfolios 1 to 6. I can see expected return of the portfolio. I can see standard deviations of the portfolio. The expected return of the market portfolio is 12% with an accompanying standard deviation of 4%, while the risk-free rate is 5%. Risk-free rate is 5%. Yeah, very favorable. So they want us to use CAPM. No, not CAPM, but capital market line. Capital market line is the one that uses standard deviations to measure risk. It uses standard deviations to measure risk. Advise the investor on which portfolios is inefficient, efficient, or super efficient. So they want me to use CML. So remember, we have what we call CAPM. CAPM is also known as the SML. And if you remember very well, the CAPM returns are normally given by risk-free plus ERM minus risk-free, in this case here, multiplied by what here? By beta. Multiplied by beta. Yeah, remember, SML stands for security market line. Don't forget that. Security market line. And then now we have, ladies and gentlemen, what we are calling the capital market line. So the capital market line, which is my CML, is also known as the portfolio equation. Is also known as the portfolio equation. Is also known as the portfolio equation. So here we normally use standard deviation to measure risk. Remember CAPM, we are using beta factor. All right. Ladies and gentlemen, come here and write the CML. So CML, forgetting returns of a security or returns of a portfolio, this will be RF plus we have here ERM, expected returns of the market, minus RF multiplied by, now here we talk of standard deviation of the security all over the standard deviation of the market. Yeah, CML returns. Let me know once you ninjas, CPA ninjas, once you're able to write up to here, can I kindly get a sign of approval over yes or why? Great, thank you so much. Let me ask you a question. You know, these two equations are supposed to be very, very similar. But how comes in this case here we are not having here beta M? How comes you're not having beta M to match with this one? It's because beta M is always equal to 1. Beta M is always equal to 1. Very, very important. Very, very important. Beta of the market is always 1. Thank you. So then, I will be able to just use this CML equation for 2 portfolios alone, because we're just revising 2 portfolios, which is portfolio 1 and the portfolio 2, only those 2. I'll not go up to 6. We are just revising here, remember? So using CAPM, not CAPM, capital market line, advise the investor on which portfolio is inefficient, efficient, or super efficient, sorry. So we start with portfolio 1, oh yeah. So portfolio 1, what do we have here for portfolio 1? So portfolio 1, we have our CML returns, which are risk-free, plus ERM, minus risk-free. And because these are CMLs, we have here standard deviation of our portfolio 1 divided by standard deviation of the market. So in this question, are you great ninjas here able to see the risk-free? Are you able to see the risk-free return? Just before required, they're giving us the risk-free return to be what here? To be 5. You can decide to leave out the percentages. 5 plus, how about expected returns from the market? Still on that paragraph before required, you can see the expected return on the market portfolio is 12 minus risk-free, which is 5. Have they given me the standard deviation of portfolio 1? Is there anybody who is able to see the standard deviation of portfolio 1? Standard deviation of portfolio 1, it's given there. It is 8. So we have here 8 divided by the standard deviation of the market. Standard deviation of the market, ladies and gentlemen, the standard deviation of the market is given somewhere here. Yeah, the expected return of the market portfolio is 12% with an accompanying standard deviation of 4%, or 4, like that. So here you have to be a bright ninja. So it will be 5 plus open brackets, 12 minus 5, you close brackets, you say times 8 divided by 4. You give me a figure. So in this case here, it is what here? It is 19. So then remember, whenever they want you to do an efficiency analysis, they want you to carry out a profitability analysis. And the person who is behind profitability analysis is known as Jensen's alpha. Jensen's. So come and give us the Jensen's alpha value. Give us the Jensen's alpha value for portfolio 1. So we know that this Jensen's alpha value for this portfolio, it will be the expected returns. What do we expect? Minus the CML, because you're using the CML model. If it was CAPM, I would have said minus CAPM. Minus CML returns, like that. So for this particular security, do we know how much we are expecting? So how much we are expecting? You can see under portfolio 1, we have an expected return of 19. Expected return is 19. So many people confuse expected return of a security with ERM. Remember, ERM is normally the same for all the securities, but this fluctuates. So then this will be 19 minus, in this case here, 19. So 19 minus 19 gives me what here, somebody? A profit of 0. So when the profit is 0, we say we are able to break even. When we are able to break even, we say that we are just efficient. So it means that portfolio 1 is efficient. So efficient. So in this case here, portfolio 1 is efficient. Portfolio 1 is efficient. Remember, if it's loss-making, it will be inefficient. Loss-making, if you get a negative, inefficient. And if it is profit-making, positive, then we talk of super efficiency, like that. All right. So this is efficient or properly valued. Properly valued. Properly valued. So then if that is rather agreeable by yourselves, let's just do one more portfolio, which is portfolio 2, and that will be the end of that question. We're not here to do all the questions, right? So in this case here, we do portfolio 2 alone. So for portfolio 2 alone, I'm going to use this same formula. And my book is very nice because I will come and rub here. So we talk of portfolio number 2. Portfolio number 2. Yeah, if you're a genius as well, you can modify your book like that. You can modify your book like that. So for portfolio 2, I want us to get this. RF, of course, RF never changes. RF risk-free is 5. It's given the question. Expected return of the market, this is the umbrella portfolio, covering all the portfolios. So the ERM never changes. Please, for the ERM, don't tell me that ERM for portfolio 2 is 25. No, that 25 is expected return of portfolio 2. I will use it when I'm looking at profitability analysis. So expected return never changes. So this is it 12 or 14? It is 12. Minus again 5. But now I have to be very careful with the standard deviation of portfolio 2. Is there somebody who is able? Is there somebody who is able? A good question there. Is there somebody who is able to see, in this case here, the standard deviation of this portfolio? Standard deviation of the portfolio, second portfolio, is 12. That changes. Divided by the standard deviation of the market. Standard deviation of the market ni ile inabaki the same. That never fluctuates. Inakuwa ngapi, somebody? 4. And remember, if you want to put percentages, you put percentage in all of them. But for portfolios, we always prefer, in this case here, leaving the percentages out. So somebody is giving me a figure of what here? 26. 26. All right. So remember, like somebody is telling me to differentiate between this expected return of the portfolio and the expected return of the market. All right, I'll be able to demonstrate that. But when I come here to the Jensen's alpha value, you see Jensen's alpha value, we are looking at expected return of the security, or P. A security in the portfolio, the same. Of course, we have many securities forming a portfolio, but for equation purposes, you can use them interchangeably. So minus the CML returns of S, like that. So are you able to see the expected return of this particular security, which is security number 2 or portfolio number 2? Or portfolio number 2. So if I look at this, ladies and gentlemen, in this case, I can see it is 20 what here? It is 25, right? Expected return of this security is 25 minus CML returns that I've gotten here, which are 26, which gives me minus what here? Loss making. So if it is loss making, it is what here? It is inefficient. 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 If it's loss making negative, that's inefficient. Unapotoka kwa nyumba asubuhi mmekosana kidogo na mama namna hii, ama unapata mama anaambia mzee atuwewe sasa unaji overvalue sana. Unaji overvalue. Hiyo ni matusi. Yeah. So anytime in this case, ladies and gentlemen, a security is overvalued, it means it is good for nothing. It is basically inefficient. Inefficient. So in this case, inefficient is the same as what here? An overvalued security. Yeah, how did this Jensen's alpha value come in? It's because of, look at note 1. Using capital market line, advise the investor on which portfolio is inefficient, efficient, or super efficient. So we use what we call Jensen's alpha value. Yeah. So then, ladies and gentlemen, it's used for profitability analysis like that. So I think with that, at least you guys have an exposure. Now you can continue with the others. If it was positive, if we get any one of them having a positive alpha value, then we call it what here? Super efficient. Super efficient. So can I go to Roman 2 of this question now? Can I go to Roman 2 of this question? Great. Let me go to Roman 2. So Roman 2, in the case of inefficient securities like this one, and the super efficient portfolios above, compute the standard deviation that the portfolio should have for efficiency to be achieved with a given expected return. Easy. So like now we are going to analyze portfolio number 2, because portfolio number 2, we have found it to be inefficient. How do we change it to become efficient? How do we change it to become efficient? We know that for efficiency to be achieved, expected return should be equal to CML returns. And now remember, we are looking at portfolio number what here? Portfolio number 2. Yes, it shall be uploaded. Yes, Jonathan. So are you able, ladies and gentlemen, in this case here to tell me the expected return of portfolio number 2? Is there anybody who can see the expected return of portfolio number 2? Abracadabra. It is 25. So 25 should be equal to the CML returns. Here now I will use the equation. The equation, of course, I start with risk-free, 5, plus expected return of the market, 12, minus 5. But now remember, with the standard deviation given there of 12, they are getting a bad portfolio. So they want you to calculate a standard deviation that will be able to make this security efficient. If you look at the question, Roman 2, in case of inefficient and the super efficient portfolios in C1 above, compute the standard deviation. So standard deviation here is what is not known. Yeah. All over the standard deviation of the market, standard deviation of the market does not change. What was the standard deviation of the market, ladies and gentlemen? What was the standard deviation of the market? Yeah, 4. So then your role is to make this the subject of the formula. So the very first thing you'll do is to have this going to the other side. When it crosses over the equal sign, you can't cross River Jordan and then your life remains the same. Ask Honorable Raila Amolo Odinga. You can't cross over. Yeah, so in this case here, things must change. Here it is positive. On the other side, it becomes what here, negative. So this will be 25 minus 5 equals 12 minus 5, that is 7. So 7, standard deviation here, over 4. Yeah. So then 25 minus 5 gives me 20. So 20 equals 7, standard deviation, 4 like that. So then abracadabra, take 4 the other side. So therefore, standard deviation of the security will be 20 times 4 all over 7. All over 7. All over 7. All over 7. So then you are able to get this new standard deviation. So remember, for efficiency to be achieved, we expect Jensen's to be 0. And for Jensen's to be 0, expected return of a security must be equal to CML returns. Must be equal to CML returns. Some great ninjas, they are telling me that this is 11.43. Is that okay, ladies and gentlemen? Percent, if you wish, you can return it there, but the examiner can never give you a wrong. So I believe, ladies and gentlemen, you know, my role at this juncture, tulisema sasa tumeshaingia kwa labor ward. Yeah. Karibu tupate mtoto hapa karibuni mbeleni hapa. So kazi yangu ni kukuonyesha tu hints hapa na pale. Wewe utabaliza swali ama utaenda rudio concept tu kidogo tu. Baadaye uweze ku deliver vizuri. So can I go to a different question? Because nilimwambia mwalimu at times you use very irrelevant and bad examples where we shall overcome. We shall overcome. We shall overcome. We shall overcome. Thank you so much. But have you been able to pick some concept? I could be moving a bit fast. Have you been able to pick some concept that you can use in an exam? I move a little. Yeah, great, very much. This is really important for you. Very, very important. Very important. All right. Sasa kuja hapa, tutoa hiyo. Yeah, asante sana Janet. We are overcoming. Thank you so much. Thank you so much. Very good. Very good. So can I rub this very fast now? Yeah, thank you so much. Great. Great, 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 great. Great. Yeah, a good question there. Remember, ladies and gentlemen, you have to be, you must know how to, you know, the examiner can use these terms interchangeably. Yeah? The examiner can use these terms interchangeably. At times he'll ask you using portfolio equation. Portfolio equation, I've seen him doing this severally, is CML. So even if he gave you beta somewhere, because he wants to confuse you, and then he asks you to use portfolio equation, please work with standard deviations. If in this case he gives you whatever standard deviations, whatever, and then he comes and asks you, how about you making use of CAPM? CAPM equation, at times they'll tell you to use SML, security market line. Yeah, so always know that here we are using what here? We are using beta. Here we are using standard deviations like that. Thank you. So the last thing that I'm doing here, ladies and gentlemen, yeah, the last thing that I'm doing here, ladies and gentlemen, is just something very small here. Something very, very small under portfolio. What if you are given a question like this? What if you are given a question like this? So they give us here risk-free. They tell us risk-free is 8%. But now they have given us 3 states. So states, we have state A, B, C. All right. And then they'll come here and they give us the market premium. The market premium. The market premium. Yeah. So this is a 6%. This is 8% as well. Just like this one here. And then we have 10%. And then they'll come and they give us the sensitivity factor. Sensitivity. factor. 0.2, 1.2, 3.5, like that. Remember, sensitivity factor is the same as beta factor. Beta factor, like that. Beta factor. All right. And then you are required, ladies and gentlemen, in this case here, you are required to calculate APM returns. APM returns. Calculate APM returns. Calculate APM returns. Yeah, V, remember V, at the end of the day, SML. SML is CAPM. Not that SML is applicable in CAPM, it's CAPM purely. So they're giving me answers there. Remember, APM stands for what, ladies and gentlemen? APM stands for arbitrage pricing model. APM stands for arbitrage. APM stands for arbitrage pricing model. Pricing model. It is a multivariate model. We have many variables. Multivariate model. Multivariate model. Multivariate model. It's a multivariate model. So calculate APM returns of a security. So, ladies and gentlemen, when you give me this kind of a question, if you have been able to write it down, I will be able to give you an answer pretty fast, because I know the formula of getting the APM returns. So APM returns, my good students, will be risk-free plus expected return of a security given factor 1 minus risk-free multiplied by the sensitivity factor 1, right? Plus, in this case here, because you have many factors, expected return of that security given factor 2 minus risk-free multiplied by beta 2 plus end of thinking capacity, etc. So remember, it is the normal CAPM, except for the fact that now here we have many factors. All right. Now, ladies and gentlemen, in the question that we happen to be having, we know that the risk-free is 8%. So this will be 8. Plus, remember, whenever this subtraction has been done, when you take away risk-free from the expected returns, we call this one premium. This is premium. So whenever you see an examiner giving you premium, you shall never be doing any subtractions, because premium means over and above. So whenever you see the examiner giving you premium, he has already taken expected returns minus risk-free. So in that case, you can see this is the premium for the first factor. So I'll not say 6 minus 8. I'll just write 6 without the percentage. 6 times beta 1. So you can see beta 1 is this beta for the first state. So 0.2. Plus, we have the second one. The second one is 8. So 8 times beta 2, 1.2. Plus, my good students, we have here 10 without the percentage. 10 times beta 3, 3.5. So is there somebody who can give me this combined APM, my good students? I'm being given a figure of 53 point what here? 53.8. The number of years I've marked these exams, whenever they're asked this kind of a question, most of them will only take up this A alone. That's why you saw so many of them giving me 9.2. I knew the 9.2 was pretty much wrong. Remember, APM is about multiplicity. It's about many factors. Yeah, great. So have you been able to pick something new, ladies and gentlemen, out of this discussion? So Rosaline is asking, what about if you do one by one? So for example, you take like, yeah, that is still very good. You take, for example, like this times this, yeah, this times that, yeah. People do it that way, this times that. And then you get the total, and then you add risk-free. Still, that works very well. That works very well. That works very well. That works very well. Yeah, that works. What this person is saying, and that's why I like, teaching students, in this case, who have been taught by many teachers. What this person is saying is that you come and attach risk factors to this. So like now you say here, 6 times what here? 6 times 0.2. You have an answer. Then you have 8 times 1.2. You have an answer. Then you have 10 times 3.5. But now come and add total here. Whatever total you get here, you add to the risk-free. Because remember, ladies and gentlemen, remember, we are teaching you guys to be what? To be rich. And for you to be rich, you need to combine securities. Yeah, you need to combine securities. You need to combine portfolios. Make great portfolios consisting of what we call risk-free and risky assets. So like now under APM and CAPM, we must always have risk-free as the base. Risk-free as the base. And you need to start accumulating your risk-free assets, ladies and gentlemen, from the time you get employed. Like for example, if you are here and you are employed and you're not saving into a pension scheme like Britam, trust you me, ladies and gentlemen, let me just show you, let me show you something here, just 1 minute. Let me show you something here, ladies and gentlemen. Just a minute. What about portfolio for portfolio 2? Just a minute. Just a minute. Alfred, I haven't understood your question, honestly. I'm trying to figure it out, but I haven't really figured it out yet. Oh, I was muted. Oh. I was muted all along. We shall overcome. We shall overcome. We shall overcome. We shall overcome. Actually, it means that this is irrelevant. This is irrelevant. Now, this is irrelevant. This is irrelevant. Now, please listen and listen to me very well. What your examiner will do, your examiner will come here and he will tell you that A is, for example, a foreign exchange factor. Foreign exchange factor, he'll tell you that. Yeah. And then it'll tell you that B is a market factor, a market factor, a market factor. Maybe C is a profitability factor or whatever. A profitability factor. This is what the examiner will do for you. So after you've gotten APM returns, which in this case here looks at many factors, the examiner will come and tell you, hey, how about you giving us CAPM returns? Give us CAPM returns. So CAPM returns, we know the formula, we are rich. We have to start with risk-free. Plus, in this case here, the market now securities, which are now risky. The market securities, we have here ERM minus RF multiplied by the risk factor. Remember, this one we don't multiply by risk factor, there's no risk at all. So in this regard, remember our risk-free is 8. I will only, ladies and gentlemen, come here and consider, because CAPM considers market factor alone. CAPM does not look at these other factors. CAPM is a univariate model. So you're looking at only one factor, which is market factor. Don't forget that. And the market factor has a premium of what year of 8. Times now it's a corresponding what year sensitivity times 1.2, like that. So are you able to give me that answer? So whenever they ask you about CAPM and they have given you many factors, they have given you many states, you have to read through the states and pick the one that is market-based, because CAPM is univariate, one variable, and it's market variable. And it's market variable. 17 point what year? 17.6. 17.6. So I hope you'll never forget that, my good students. I hope that will be able to help you, my great students, come a few days from today. A few days from today. Lakini hii haijaingia vizuri sana. Hii haijaingia vizuri sana. Hebu jaribu moja. Tujaribu moja. Let's try one. Let's try April 2023, question number 3C. Question number 3C. April 2023. April 2023. Question number 3C. Question number 3C. Yeah, so remember here, Purity, they have given us market premium. They have given us market premium. Whenever you're given a market premium, already they have subtracted for you. Don't subtract again. Don't subtract again. Don't subtract again. Whenever you're given market premium, we shall never subtract again. I hope that is okay. That's why we only took that 8 as market premium, like that. All right. So then we move with speed and answer this question here. Have you gotten the question itself, you gentlemen and ladies? Have we been able to get this question? It looks scaring, but I mean, it's an easy question. Very easy question. So we are told here, you have been appointed as a finance manager of Mamba Limited. So they're giving you a very big position, so don't get a 0 in that question. After evaluating the investment portfolios of the company, you have divided the market into 4 portfolios following 2 dimensions: value growth and small/large. The weight of each portfolio in the index is given below. So I can see portfolios, I can see the weight, I can see sensitivity to factor 1. I can see sensitivity to factor 2. I can see sensitivity to factor 3. And then I can see down there the risk premiums for each one of them. Required, using arbitrage pricing theory model, APT, determine the portfolio that has the highest expected return. Easy, easy, easy. There is nothing there. Easy, easy. I will start with the first portfolio, which is small value. So small value. So small value, what do we have here? I can see they have given me for small value. I can see I have factor 1, factor 2. I have factor 1, factor 2. Then I have factor 3. Factor 3. So for small value portfolio, I can see first of all they have given me risk premium applicable to each factor. So for example, the risk premium more. Factor 1 is 8. I can put this percentage. Factor 1 is 8. Factor 2 is minus 3. Factor 3 is 0.4. 0.4 like that. And then now we have what we are calling beta. Beta. Beta is a sensitivity factor. Beta is a sensitivity factor. Like that. So are you able to see, ladies and gentlemen, the betas? The betas. Are you able to see the betas? Oh yeah, for small value alone, row-wise. For small value, beta for factor 1 is 0.87. Beta for factor 2 is 0.83. Beta for factor 3 is 2. Is 2. Is 2. Is 2. And then now they want you to give them what here? They want you to give them APM or APT. APT returns. So how do I get APT returns? Easy peasy. It is risk-free plus ERS. Or rather, because they have given me risk premium. So I will take premium. I will take, in this case here, premium for factor 1 times beta 1. Because they've given me premium, I don't have to subtract. Plus, in this case here, premium 2 times beta 2. Plus premium 3 times beta 3. So, ladies and gentlemen, is there somebody who can read for us the risk-free rate? Anybody who can read for us the risk-free rate in this question? Abracadabra, life is good. Abracadabra, life is good. Risk-free rate. Wairimo amenyamaza sana siku hizi, kusema ukweli. Wairimo, David Wairimo amenyamaza sana. David, the higher you go, the better things should become. The cooler. Yeah. So risk premium, wamesema risk free is 3. Plus premium 1 is here. Premium for factor 1. So nachukua 8 times beta 1.87 plus minus 3 times 0.83 plus 0.4, because I'm picking the premium, times 2, like that. Give me an answer. So Magi ameniambia ni 8.27. 8.27. Kwa exam ungefikiria hivyo kweli? Niambie ni ukweli. Kwa exam ungefikiria hivyo kweli? Kwa exam ungefikiria hivyo? Hakuna yes. Hakuna yes. We shall overcome. We shall overcome. We shall overcome. Kidogo. Great. So tuende kwa the next portfolio. The next portfolio is called small growth. I'll only do 2 of them. The next portfolio is called small growth. I've finished with small value. So nikupatia dakika moja uangalie small growth. Tuone utaandika. Portfolio called small growth. Portfolio called small growth. Portfolio called small growth. So the factors will still remain, right? The risk premiums are not changing. Risk premiums, they're given down there on factor basis. They're factor-based. They are factor-based. The risk premium will not change. What is changing are the sensitivity factors. Sasa Dennis umeanza kulia. Deno. Deno unalialia kwa nini Deno sasa? Deno unalialia kwa nini? So small growth, we have 0.97. 0.97. So we have here a small growth factor 2 is 0.33. 0.33. Then we have, ladies and gentlemen, 2 like that. 2 like that. So then now do your abracadabra, give me an answer. Do your abracadabra, give me an answer. Sawa. Sasa si tuende basi Roman 2 ya question sasa. Notaleza is a question. Si tuende kwa Roman 2. Tuende kwa Roman 2 sasa jameni. Alafu tafadhali, wherever you are seated, it's a taboo. Where I come from, huwezi kaa unaangalia mwalimu umeshika hivi. Hata uandike chochote. Mimi sijakukosea. All will be well. I'm telling you. Hata kwa ujoko ukisoma, so long as uanze kusoma leo. Usianze kesho, utapita imagine. So kubweko na bweko kama unajishika hivi mimi sijui. No. Nisonge yes. Sawa, hiyo nakubali. Hiyo nakubali. Hiyo nakubali. So please changamuka wherever you are. All of us are going to pass. You are overcoming. We shall thrive, that one I can assure you. So long as tuanze kusoma kutoka leo. Kutoka leo. Mimi ni chief overcomer. I always believe in miracles. Chief overcomer. So long as uweze kusoma kutoka leo na uweze kuangalia vitu positively. Positively, yes. Ikiripita, okay, great. We shall overcome. So can I then go to Roman 2, my good students? Liaka more doubt. Mini chief overcomer, I've always, perhaps I could be the only product of what here, miracles. Me, I believe in miracles. So long as uanze kusoma leo, unasoma hivi ambavyo unafanya mwisho za low hanging. Unaona kama hii AFM. Let me tell you something. Do you know this AFM, although not for this semester, do you know this AFM can be set in a way that even if you went to school or not, all of you are going to be at the same level. Yeah, but there was no good reason for you even to have attended anybody's class. Yeah. So then in this case, here, what will be able to differentiate between the two students? Confidence, theories. But if you are that kind of a student, mwanajishika hivi kwa class hivi, we juu anza kutoka leo. Kutoka leo, ushikashika hapa kidogo kidogo, itakuwa sawa. Itakuwa sawa. Ati hakuna miracle. Aya. Sasa mimi nitaacha na ninyi. Kama nyinyi muamini miracle, mimi sasa sijui nitawafanyia nini. Mimi na believe na overcoming sana. Sasa tunaenda mpaka siku ya mwisho lakini uanze kusoma leo. So hebu nifanyie number 2. Number 2 anasema you give us the CAPM returns. You give us the CAPM returns. The second one, they want you to give us the CAPM what here? The CAPM returns. Oh, niseme kwa sauti Part 2. Part 2, ladies and gentlemen. Part 2, they want us Aya. Wewe Magi wewe namna gani? Hata huku kwa hiyo club ya kutoamini. Aya. Do you want to tell me that you guys really deserved to have passed MA? I want to believe there must be somebody who thought that this MA they were to get like even 30%, but here they are in the advanced level. Same case with the FM. Yeah, they thought this one failed. But God is there. So to me, of course, I believe we shall work hard, but God is there. Trust you me. God is there. God is there. Yeah, like what Alfred is telling us. We have over 200 hours the exam. Yeah. So I'm waiting for someone to give me the answer to the first one. Janet already has an answer. KG already has an answer. Thank you so much. So is there somebody who would want me to do that question? Anybody would want me to do this question of CAPM, or all of us are comfortable? They want me to do it, eh? They want me to do it. No problem. Okay. Okay, I will be able to do it. Okay. I'll be able to do this. So they want me to give them CAPM. So I know that CAPM is a market. This is a univariate model. Univariate means one, eh? And we are only going to consider market variable alone. Market variable or market factor. Market variable or market what year or market factor. Great. That's why you normally say CAPM returns. CAPM returns equals risk-free plus ERM minus risk-free into beta of the security. But again, remember, this is a situation where they have given us premium. So when they give us premium, my CAPM returns will be risk-free plus premium multiplied by BS. Remember, premium will only be given. Yeah, if it's given, don't subtract. So the risk-free, ladies and gentlemen, that we have here for small value, for small value portfolio, for small value portfolio, then my CAPM returns. I will forget about the many factors. The only factor that I'll be able to consider is the market factor. Yeah, you can see like sensitive to factor 1, and they're telling you that is market beta. Then we have sensitive to factor 2. They're telling you that is price per book. That is irrelevant for me in terms of what here? In terms of CAPM. Even factor 3 is average capitalization, irrelevant. So I'm only going to use small value. I'll be using this market beta of 0.87. Therefore, the risk-free remains free plus the premium for the market factor. The premium for the market factor, is there somebody who is able to see 8? Are you able to see 8? The premium, it's given down there. For market factor 8 times the beta, which is the sensitivity factor. For small value, 0.87. So are you able to give me this figure now? Masikorir, great, 9.96. So now I believe you can do the same now for all the others. You can do the same for small growth, isn't it? You can do the same for small growth, etc, etc, etc. Is that okay? Oh, those yeses are very few. Actually, it's only one yes. Ah, already somebody has it. Roman 3. Let's go to Roman number 3. Roman number 3. So Roman number 3, in order to diversify his perceived risk, a competitor wants to combine the small value and large growth portfolios. So it's SV small value and large growth portfolios. The new portfolio should have an overall sensitivity to factor 1, market beta of 1. Determine the proportion to be invested in the small and large growth. You see, there are two methods of calculating proportions in portfolios. Two methods. Which methods are these? There is the easy one, like now this is very easy. And then there is what we call the covariance approach. Covariance approach. Why am I saying that this is easy? This is easy because they want me to combine two portfolios, small value and large growth. So I will let their proportions in this case here to be, let me use this weight 1 and this to be weight 2. Remember, proportions are the same as what here? They're the same as weights. Great. They're the same as weights. These proportions here. So then what I would want you to do is to come and give me beta, yeah, arising from each one of them, arising out of the market factor. The sensitivity factors. So is there somebody who is able to see the beta market factor for a small value? Or you talk to me. Just talk to me. Remember, we have been conditioned to use market beta. Market beta, sensitivity factor, which is the same as market beta. Is there somebody who is able to see 0.87? I'm alone, but I will overcome 0.87. Yeah. How about large growth? Large growth. Large growth, are you able to see, is it large growth or large value? Let's see. So we have, large growth. Actually, it's large growth. So large growth, what are you able to see there? 1.12. So we have here 1.12. 1.12. So then form two equations. This one here, we can't see covariance. When you're not able to see covariance, ladies and gentlemen, they want you to form the two equations. So come and give me the weighted beta. Give me the weighted beta. How do we get weighted beta? You take weight 1, beta 1, plus weight 2, beta 2. All right. So this will be weight 1 times beta 1 here, which is 0.87, plus weight 2 times 1.12, like that. So then this, ladies and gentlemen, boils down to 0.87 weight 1 plus 1.12 weight 2, which must be equal to 1. Because I've told you that the combined beta to be equal to 1. The combined beta, read the question again. In order to diversify his perceived risk, a competitor wants to combine small value and large growth portfolios. The new portfolio should have an overall sensitivity to factor 1, market beta of exactly 1. The overall, the weighted beta should be equal to 1. And then, ladies and gentlemen, we know that these weights, if these are the only two portfolios that you have, the two weights must always add up to what here? Must always add up to 1. The two weights must add up to 1. So then your role will be to solve for the two equations. In this case, you solve for the two equations using elimination method. Eliminate. 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 Let me give you 1 minute to try this elimination method. Eliminate, 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 eliminate. The good thing is that they may easily give you this kind of similar questions. So it's just good to have that overall understanding of everything, and then we'll be able to overcome. So then to be able to eliminate, ladies and gentlemen, here, I will make 0.87 to be the constant coefficient here. So I will come here, take this as equation 2, this is equation 1. So equation 1 is 0.87. 0.87 W1 plus 1.12 W2 equals 1. But equation number 2, this is equation number 1. Equation number 2, we shall multiply it with 0.87. 0.87. So then abracadabra, this will be 0.87 W1 plus 0.87 W2 equals 1 times 0.87 as well. 0.87 like that. So please go ahead and subtract. So you subtract, tell me what is this divided by this? Not divide, but minus this. Gives me what figure? This minus this. Because of course this minus this disappears. We have eliminated. We have eliminated. Why they are not talking to me at all? 0.25, right? So this is 0.25 W equals 1 minus 0.87. 1 minus 0.87. Imewakalia. 0.13. So this is W2. And therefore W2 will be equal to who? Therefore W2 will be equal to who? Therefore W2 will be equal to who? Therefore W2 will be equal to 0.13 divided by 0.25, which ends up giving me what figure? 0.52. And then we have W1. The two must add up to, so W1 will be 1 minus 0.52, which is 0.48. Great. Life is sweet. Life is good. So if you do another similar question like this one, you'll be able to understand what I'm talking about. The very first one may not be like very good for you, but I believe I've given you some great foundation which can be of help to you. Yeah. So can I go to our last question, ladies and gentlemen, for tonight? Or are you very, very tired? Can I go to our last question for tonight? And I would want to repeat the same concept, but now this time round, proceed, yes. This time round using the covariances approach. August 2022, question number 1B. August 20, kinda, yes. August 2022, question number 1, boy. August 2022, sorry. August 2022, question number 1, boy. August 2022, question number 1, boy. Like that. Question number 1, boy. So we read. Have you gotten the question, great students, great friends of mine? Yeah. So we are told here, an investor has decided to invest 2 million in the shares of 2 companies, namely Dela Limited and Alpha Limited. Dera. Hajui Kiswahili huyu. The projections of returns from the shares of the 2 companies along with the associated probabilities are as follows. So we have probabilities and then we have returns there. So they want us to determine the proportion of each of the above shares required to formulate a minimum risk portfolio. So you see, ladies and gentlemen, here, they want us to give them the same proportions, but this time around they have given you data which will be able to help you to get, in this case here, covariance. So then the very first thing that I would want you to help me get is the expected return of Dela. So remember, they have given me probability, and then we have returns. Dela. Yeah. So probability is 0.2. Here we have 0.25. Here we have 0.25. Here we have 0.3. The Dela returns, they are 6. There are 7 there. They are minus 3.5. They are 14. So then could you kindly take, in this case here, this times this? Give me the expected returns here. So we have here, in this case here, the Dela returns times probability. Please do that for me. So like now 0.2 times 6. How much are we getting there? Already somebody has finished. 1.2. This times this gives me what figure? This times 7 gives me what figure? 1.75. Thank you very much. This times this gives me what figure? So this gives me minus 0.875. This times 14 lastly gives me what here, ladies and gentlemen? So this, I'm being told, gives us 4.2. So please come here and give me expected returns of Dela. Add this. Expected returns of Dela. So I'm being told it's 6.275. Then in this case here, we have the other returns. We have alpha returns. So alpha returns, what do we have here? We have 8. We have 5, 14, minus 1. So create a column here for RA times probability. We are sharing the same probabilities. So 0.2 times 8. Give me a figure. 1.6, thank you very much. Then we have 0.25 times this 5. Yeah, I'm being given a figure of 1.25. Then we have 0.25 times 14. Times 14. We have here 3.5. Thank you very much. Then lastly, we have 0.3 times minus 1, which gives me minus 0.3. So please go ahead and give me the expected returns of A. Because now, you know, these are expected, because now we have involved probabilities. These are expectations now. These are expectations. So somebody is giving me a figure of 6.0 what here? 6.05. 6.05. Now, ladies and gentlemen, after you do that, because now they want me to give them the optimal proportions, and they've given me information which can help me get covariance, so then I have to come here and compute covariance. Covariance between A and D. A and D. So how do I get covariance between A and D? So I will take the deviation of A times deviation of B. Deviation D times probability. So to get covariance, let me write very well. Let me write very well. So to get, in this case here, covariance, to get here, covariance between A and D. Take deviation of A multiplied by deviation of D times, in this case here, probability. So deviation of A is returns of A minus expected returns of A, like that. Division means subtraction. And then deviation of D, it is a returns of D minus expected returns of D. Whatever we get times probability. And then we shall be able to come and sum. So fortunately, we have these returns. Yeah, we have returns of A, like I come and start with returns of A. So we have 8 for A, 5, 14, minus 1. And then I say minus. Do I have expected returns of A? They are there. And these expected returns of A will not fluctuate. They will remain the same. They will remain the same throughout. They will remain the same throughout. So I put like this. Like this, like that. And then we have returns of delta. So these are returns of delta. So returns of delta, we have 6, 7, minus 3.5, 14, minus. Expected returns of delta, I can see it is here, 6.275, 6.275, 6.275, 6.275, like that. Then now I have my probabilities. So we have here, our probabilities are here. So we have here 0.2. Then we have, ladies and gentlemen, 0.25. 0.25. Then we have, ladies and gentlemen, 0.25 again. Then lastly, we have 0.3. 0.3. So is there somebody who can now give me these figures? Anybody who can give me these figures? So we have here. So in this case, you don't do them like slowly, like one at a time. No. You say open brackets. 8 minus 6.05 close times open other bracket. 6 minus this close times 0.2. Give me an answer here. 2 decimal places. Yeah. The covariance, in this case here, between A and D, it is deviation of A. Deviation is subtraction. Deviation of A. Yeah. Multiplied by deviation of D, because there are 2 of them. Delta and alpha. Yeah. Times probability. Times probability. So the first one I'm being given negative what here? Negative, the first one. Please give me the first one. I've lost you guys. Give me the first one. Give me the first one. The first one, minus 0.11. Minus 0.10. They want us to write everything, no problem. Minus 0.10, 725, no problem. Let's write everything. Go to the second one, abracadabra. Open bracket here, say 5 minus this, close times. Open bracket here, 7 minus this. You close times 0.25. So the second one, what do we have there? Negative 0.1903. Negative 0.19.03. Good, we are doing very well. Go to the fourth one. Now we are on the third one, before we finish. Now we are on the third one. The third one, open brackets there, 14 minus 6.05, close bracket, times minus 3.5 minus that key number times 0.25. So according to Winnie, we are getting 19 negative, eh? So we have here 19.4278 negative. Thank you so much. How about the very last one? We do it with one stroke of the pen. We do it with one stroke of the pen. Yeah, so I'm being given a figure of negative, 16.3384. Let me get some confirmations. Thank you so much. So come and add up everything. You add up everything. So in this case here, the covariance between A and D is that. Remember, covariance is the shared variance, common variance. If you are a baby girl here and you pass by somewhere, and then you hear in this case here someone saying, pointing your way, that is my co-wife. Where? Shared variance. Shared variance. Very, very important. Shared variance. Covariance. Shared variance. So you can see that's why we are taking in this case here. This is polygamy, polygamous life. You can see we have yeah. So is there somebody who is able to add up everything for us and give us this covariance between A and D? So I'm being given by Mildred. It's negative 36.0606. Oh, sharing is caring. Wow, great. We shall overcome. Great. We shall overcome. We shall overcome. 36.0637. Thank you very much. Great. Great. So I don't know whether there is somebody who has been able to learn how to get this covariance. Is there somebody who has been able to learn? I mean, I know you knew this, but at least now, given that we are going through it one more time, you must have gotten even better insights. Better insights. Now, after that, if it's this optimality in terms of proportions, I need the standard deviation of A and I need the standard deviation of D, candle. So come and give me the standard deviation of A. Let's start with A. So standard deviation, right, like this, of A. So this one here will be the deviation of A. Deviation of A squared times probability. You sum like that. So you take deviation of A. So we have the standard deviation of A will be deviation of A. Already we have it there. It is RA minus ERA. We square this times probability. And then, of course, we sum. Then square root like that. So basically, you come and take, this is A. So you say 8 minus 6.05, you square times this probability. You don't bring D here now. 0.2. So 5 minus 6.05 multiplied by the probability, 0.25. 14 minus 6.05. You're squaring everything, remember? Yeah. Times 0.25 again. And then we have, ladies and gentlemen, here, minus 1 minus 6.05, you square times the probability. So is there somebody who can kindly do this pretty fast for me? And then they add up everything. I just want the total now. I just want the total here. I just want that. I don't want to write those individual things now. I don't want to write those individual things. I want the total now. Now I want the total. Please do them kando, kando, kando. And then you give me the sum here. I'm so happy because you've been able to maintain that high number of 133. I'm so sure there must be somebody who is really finding it to be very hot. But please, just hang in there. You will pass. Trust you me. You will pass. You will pass. Trust you me. You will pass. A 100%. You will pass. 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 You will pass very well. Liaka, you'll pass. Don't you work in class and in the office? Being an accountant is not easy, but accounting pays very well. Accounting pays very well. So according to Winnie Ndaku, she's getting 5.63 Masikuri, 5.6345. 4 decimal places to be consistent, eh? So I'm waiting in this case here to get what other students are also. Hey, Grace, yours is quite far. Or is it Mildred? Have you already taken the square root? Is this the final answer? Or you want us to come and get the square of the same? So remember, after you get that total, you must give us the square root, eh? Or it is 31, it's supposed to be 31.7475, eh? So the final answer here, this standard deviation of A is supposed to be the square root of 31.7475, which now gives me what final answer? 5.6345, like that. Thank you so much. Then go ahead and give me the standard deviation of dog now yourselves. Go ahead and give me the standard deviation of dog. So remember, this answer here is 31.74 or thereabout. So go ahead and give me standard deviation of dog. Standard deviation of dog. So standard deviation of D. This is the last thing that I'm doing, I go away. Don't hate me. It's the last thing I'm doing and then I go away. So standard deviation of dog, already I have the deviations of dog. I have them. So it's very easy. Mine is to come and make them special. Yeah, I will come here, square times this probability. So the second one, we have 7 minus 6.275 I square times 0.25. And then we have in this case here minus 3.5 minus 6.275 we square times 0.25. And then we have in this case here 14 minus 6.275 we square times 0.3. Whatever you get, I simply want the total here, and that total, come and take the square root of that answer. Give me the final answer for D. I want the standard deviation of dog. I want the standard deviation of dog in the next 2-3 minutes. I know you have hated me enough. That's okay. That's okay. Yeah. Were it not for exams, I'm so sure I'll not be here troubling you. No, I love my students. I love my students. I love my students. So I'm being told that the standard deviation of dog is 6.47 or 6.48. 6.475. Let me see how many ninjas are able to get this. Eric Bill, 6.467. Good, that's well within the accuracy ranges. Well within the accuracy ranges. If you've been able to get that 6.4 something, could you kindly put your thumb up like this? Put your thumb up like this. If you've been able to get the final standard deviation of dog. Final standard deviation of dog like that. Put your thumb like this. Like this. Thank you very much. And if you have not been able to get it, could you kindly show me a thumbs down? Show me a thumbs down like this. Yeah, without, I mean, it's good to tell the teacher that mwalimu, I've tried my best and I've not been able to get it. But from the sign of things, most of you are able to get that standard deviation. And that is it. So then you can now come here and give us the weight of A. Now you can come and give us the weight of A as we disappear now. Come here and give us the weight of A. So how do we get the weight of A? So to get the weight of A, sorry, Alfred. To get the weight of A, oh yeah, we shall take the standard deviation of the other product. You take the standard deviation of the other product, you square, minus covariance between AD. All over, so this is D. D. If you want to get weight of A, you take this standard deviation of D squared minus covariance of AD divided by the variance of A, the variance of B, minus twice covariance of AD. Minus twice covariance of AD. Very important formula. You shall be able to use this formula in your exam. Already, ELO has been able to get it. I don't know why I rubbed my figures, but in this case, you guys should be able to remind mwalimu. The standard deviation of dog, this one you're given it to me. The standard deviation of dog, you are given me 6.46, 6.47, 6.475. So you square it. The covariance already, I've forgotten the covariance. The covariance already, I have forgotten the covariance. Is there somebody who can remind mwalimu what the covariance was? Anybody who is, it was negative something. I don't know, I know it's negative. Negative 36.064. 0.064. Thank you so much. Yeah. And then now you have to remind mwalimu what the standard deviation of A was. What was the standard deviation of A? What was the standard deviation of A? In the next 2 minutes, I'll be out of this classroom. 2 minutes only. 5.6295 squared plus, in this case here, 6.475 squared minus twice the covariance. Covariance, which is minus 36.064, like that. Minus twice the covariance. And the covariance itself is negative. The covariance itself is negative. So unaanza na numerator. Is there somebody who can give us the numerator answer here? Anybody who can give us the numerator answer? Oh yeah. You take this squared minus this. Give me the numerator answer. Give me the numerator answer. According to Joey, it is 67. According to Joey, it is 67 point. They're giving me different. Please remember there is a minus and a minus. There are two of them. There are two of them. So I'm being told it is 77 point something, isn't it? 77.88 whatever 6. How about denominator? Denominator, come and take this squared plus this squared minus this times this. Give me an answer. Give me an answer. Give me an answer. We are overcoming. Give me an answer. We are overcoming. Oh, I'm alone. I'm alone. I'm alone. I'm alone. Give me an answer for the denominator. 145.74. Which gives me what final answer here? 0.53 or 0.52, the same. So if the weight of A is 0.53, what do you think will be the weight of dog? sorry. So see you tomorrow, ladies and gentlemen. I was trying to explain that I know it has been a tough session, but you must have gotten something that will be able to catapult you, remove you from any failing possibility. Should they bring something around here, you'll be able to get a few marks here and there. Otherwise, see you tomorrow. Thank you so much. Bye. Ninjas, bye. Yeah. Good night to everybody. I believe now everybody is okay. Yeah, that is the final answer, yes. Yeah, we shall discuss in the group. Kesho in the morning, LM, 7. Good night. Kesho LM in the morning. Any other classes on Sunday, we shall discuss in the group. Bye.